funding case studies. Case studies capture a range of perspectives as opposed to the single view of an individual you get with a survey response or interview. This gives the opportunity to gain a greater understanding of the subject in hand and reduces the potential for any bias by diluting the agenda of a particular individual. When it comes to a startup raising funds, case studies reduces the risk of making a few mistakes which are unconsciously made. For this session, I would like to invite Mr. Ravish Ratnam to drive us through some amazing case studies. Mr. Ravish Ratnam is the founder and managing partner of PointOne Capital. PointOne Capital is a VC fund investing in pre-seed and seed stage tech startups. They have invested into 25 plus startups and prefer partnering with exciting businesses as early as possible with no revenue or product milestone benchmarks. PointOne Capital has recently launched early stage focused fund investing in the first round of capital that a startup raises. They have a quick decision making cycle ranging from 2 days to 2 weeks and are looking to invest in 50 startups in the next 2 years. A graduate of IIT Delhi, he takes keen interest in gaming, sports, and politics in his free time. With this, a very warm welcome to you, sir. The session is over to you now.
Sure. Thanks, Kapil. And first of all, I would like to thank the entire Arthian team for very meticulously organizing this. I have been on the other side in my previous job. I was the one organizing such events. Those were the pre-COVID times, so they were offline. And I know it's not easy, right? So kudos to you guys. And also a very thank you for all the attendees because this has been a 2-day session and there are a lot of knowledge intense talks that are going on across valuations, term sheets and all. So to have sustained so much and still be very attentive in the event, right? And I have seen that the attendees have maintained the daily active user base of the event today at about 80 to 100 continuously, right? So which is good. So kudos to you guys as well. And I think Kapil has covered most of the introduction for me and my fund PointOne Capital, which was started by us about a year back, right? And we are very active investors. So even after this call, you guys can always find me on LinkedIn and reach out for any further queries, or if any of you are actually raising capital, please give me a shout, right? So with that, I'll just get started. And the whole idea of this session is that people have talked till now about important pillars in the fundraising process, right? Like the term sheet, valuations, how to create an effective pitch and all. Right now, what I will be doing is that I want to touch upon some of the important parameters that goes into the investor's mind when you go and pitch to them, right? And that I'll be substantiating through different case studies, right? So let's say we'll present one case that this is the time in which this startup with this idea, this team, and will this company get funded or not, right? So one disclaimer that I want to add here is that if as a jury I will say that okay, this company will get funded or this company won't get funded, that judgment is always probabilistic and statistical, because different investors have different mindsets, right? And I can't speak collectively for all the investors out there. So when I say that the startup will not get funded, what I would be meaning to say is that maybe 80 out of 100 investors will say no to them, but there's still a finite possibility that it can get funded. And the reason this statement that I'm making right now becomes even more important in the current times, because we live in a time wherein there is a lot of capital chasing founders, right? And for those of you who have heard Murphy's law, right, that anything in this world that can happen will happen, I have personally made a startup world equivalent for that, right? Wherein I say that in today's world, any startup that can get funded will get funded. And the reason, one is that there's a lot of capital. The second thing is that the capital is decentralized. So it's not that it's just 2-3 entities controlling, the $100 million which has to be invested at the early stages. But there are a lot of different nodes, some angels, some syndicates, some small funds like us, right? Because of which what happens is that, so basically investors have a bias, right? I will have a certain bias in evaluating startups, so someone can have a bias that I will only invest in second time founders. Someone can have a bias that I will only invest in revenue generating companies and all of that, right? So with so many investors, there's a lot of bias floating around in the market. So there's a chance that you will fit into at least somebody's bias, right? And you will get funded, right? So that's why, don't take my judgments in a way that, okay, he has said that this will not get funded, so it will definitely not get funded. There's a finite chance still, right? So, and the way I will be kind of structuring the session is that, I would want to make it as interactive as possible. So whenever I will of course not be taking names of startups, but whenever I present a case, that there's this startup with limited data points, I would want audience to also say that, had you been an investor, would you have invested in this startup or not, or what would have been your questions, right? So that's how we'll do it, and we'll see how this goes, right? So yeah, I'll just get started. So the first case, that I would want to present is, there's this startup, and let's not get into what is the name of the startup, that's immaterial. But this startup has been founded sometime in the year 2017, right, 4 years back. And the idea of the startup is that they have developed a software which is helping schools go digital and conduct their classes via video call, whenever needed. So they have given them an infrastructure tool wherein, if needed, they can also conduct, their maths classes, coding classes online, right? And they have about 20 schools using the product, and the founders are good. They're good, talented guys. One founder is a proper business guy. He knows how to do sales properly. Another founder is a good tech guy, good tech product guy, and they're focusing on the India market, right? So what do you guys think, right? I mean, just quick question. I would happy to see in the Q&A section that do you think that this is an idea which you would have funded had you been an investor? I'll just probably wait for maybe 30 seconds, 40 seconds to get a viewpoint from people. Okay, so we have one answer from Ravinder Singh. He's saying not in 2017. Samir Patil, founder of Travatel, is saying yes, he would have funded it. Anybody else? Anyway, look, so basically the point, okay, there's another person, Pratik. Multiple people are saying yes, that's great, right? So, okay, now I think we'll just stop there, because let's not go very, very deep into the startup. But yeah, I mean, I get a gist of how you guys are thinking, right? So the important point here to consider, which I think Ravinder raised, is that in 2017, perhaps we might have not funded it. And I'll tell you guys the reason why. Reason why this startup might have been rejected by a lot of people. Someone still might have taken a bet, but most of the people might have just rejected it. The reason is that if you look at it in 2017, most of the schools in India, they had no real incentive to conduct video classes, right? Because everyone, students were coming to school, schools had invested so much money in creating proper classrooms and all of that, right? And most of the schools did not even have proper teaching curriculum in place properly, so conducting video classes might have been, a step even forward, when even the basic was not there, right? So probably the only schools, who would have been really interested in something like this would have been the very top schools, right? Wherein they wanted to offer something more to their student apart from the regular classes, right? So maybe even during the holidays, they wanted to have a opportunity for students to learn something, and or rather, apart from the regular faculty which was teaching in the actual schools, they also wanted to invite some foreign faculty, which will come and maybe teach a small 2-month course to students, which will be done via video, right? Also, it might have been relevant for schools which were in rural areas. The students might not be able to come and visit, but there the paying capacity might not be very high, right? So a lot of investors might have rejected this company back then in 2017, right? Whereas some people might have taken interest still. However, if we were to just change the year, there's this time of the startup, sometime in 2017 to 2021, then you all know the answer. The answer would have been yes. Lots of people would have been interested in investing in this company had other things also been good, right? The revenue and all of that. The simple reason we all know is the pandemic that happened, and students were just not able to go to school. So something which would have been a good to have feature back in 2017 became a basic necessary in 2021, right? Because without video classes, the education would have stopped, right? I mean, schools would have stopped to exist, right? So this leads to an important point. which the VCs, which would be there in the VC's consideration when they are evaluating your company, which is the timing of a startup, right? And timing is basically the sum total of all the external factors which you as a founder cannot control, but which will impact the kind of market that you are working in, or it impact the sector that you're working in, how fast the sector is growing and all of that, right? And within timing, I personally feel that timing can be categorized into four buckets, right? So one is externalities, so like that those are the impacts of some external factors which were perhaps not expected and which are definitely beyond the control of us humans. So one is of course coronavirus. The second externality could be the onset of geo, right? And both of these in their individual capacity have been able to have a lot of impact on startups, right? And most of the times externalities will have both either a positive effect on some startups and a negative effect on some startups, right? Because of corona, a lot of startups in hospitality and all suffered a lot. A lot of startups catering to restaurants might have suffered a lot, but at the same time ed tech companies which were promoting remote working, entertainment startup, content startup benefited a lot. Likewise with the onset of geo, definitely so many companies benefited because of it, right? Because simply because internet was cheap and you had access to a huge audience, right, which could consume your products, right? The second aspect about timing, which I believe is perceptions about certain sectors, right? And these perceptions somehow get formed in the market, in the minds of investors, and they are very difficult to change. So an example that I would give is a perception like the small Indian SMEs or retail stores, they will not use software products. And this was the mentality 5-6 years back, right? That every time someone was building a software product, the thing is that okay, you're building from India, but your customer base should be outside India because Indians will not use it, right? Particularly the smaller SMEs, right? And this perception sticks in the market, and maybe once 3-4 VCs start believing it, everybody starts believing it, right? And as a founder, sometimes it becomes very difficult for you to change that perception, right? And so you might be the receiving end of the negative tailwind because of that perception, until some company comes and it changes the perception altogether, right? And a brilliant example here are, I would say, two companies called Khata Book and OK Credit, very similar companies. So you all would be aware of them. They are digitizing the Bahi Khata of in small retail stores, right? So they showed that for the first time there can be the huge adoption of a software product which is mobile first, for retail stores to bring efficiency in their day-to-day operations, right? And then they can create multiple products on top of that. And so many retail stores all across the world were using their softwares, right? So because of which now there is the perception in the market has changed. The perception has developed that you can build software as a service companies for the Indian market, for the Indian SMEs. And then you have all sorts of softwares, like HRMS software for SMEs, billing software for SMEs coming in, and they are getting a lot of funding, right? So either you can be that startup that brings about a change, or at times you can be the beneficiary of that change, right? So that is something you have to keep in mind. Likewise, like a company like Flipkart, they pioneered online ordering, right? Everybody thought that why will the Indian consumer order anything online, but they did it. And then there are so many D2C online first startups which are selling to Indian customers, right? So that is the second aspect around timing, right? Then the third aspect which I feel is that there are certain natural macro developments in the market, which happen with time, right? So like a certain macro development that has happened is that if you compare maybe 10 years back, there are more people who are investing in stock market today, right? So, and if you take even 20 years back, there were negligible people, and most of the people are putting their money only in real estate and gold and all, right? People are slowly becoming more fitness conscious, right? Perhaps the new generation, right? Another natural macro development has been the rise of millennials, right? So people of my age, people in their late 20s, early 30s, so the millennials, they have really disrupted and changed the way Indian consumers are perceived, right? So earlier, if you look at the millennials, they don't marry very quickly. They have a perennial travel bug, so they'll be traveling a lot. They do online dating, so all sorts of things, right? Which was unheard of in India maybe 20 years back, right? So maybe a startup which was kind of doing something like something around travel, so unique offbeat travel destinations, booking online 15 years back might not have been a great timing. But the market has changed, millennials have emerged, so you have a great market to tap into, and millennials are working and millennials have money to spend, right? Likewise, an online dating startup might not have worked 15 years back, but it can work very well now and even better going forward, right? So this is the third element of timing, right? The fourth element of timing could be some policy level initiatives by the government, right? So like a great example could be the EV subsidy. Government is pushing EV. So if you are an EV startup, you are definitely going to be a beneficiary in some way or the other, right? Likewise, the government started UPI account aggregation. Recently, they've even started e-rupee, right? So again, like a lot of fintech startups, and not just fintech, in general, a lot of startups which rely on online payments, they are going to be beneficiaries. Likewise, sometimes government initiatives can also affect some startups negatively, right? So basically, example being, recently we saw China has banned or has put a huge stop on a lot of after school coaching. Those kind of news has come. So clearly, a lot of startups, their valuations have gone down, right? So these are some of the timing aspects, and the unfortunate or the fortunate thing is that you can't control these things, right? So you have to just live with it, and but it will definitely be a part in the consideration of the VC, right? So like in this case, if you take today's time, a lot of VCs would have been interested in this kind of startup, and not just this, but any kind of edtech startup. Someone teaching extracurricular things, hobbies, all of that online, right? And we have seen, even the big edtech startups, small edtech startups have received a lot of funding. Likewise, because of the timing, a lot of startups, around virtual workplaces and all of that have received a lot of funding, whereas startups in travel, hospitality, the funding has dipped, right? So yeah, this is one factor which is definitely continuously going to be affecting your fundraise. The next factor that we'll get into, so I'll be giving you guys two cases, right? And again, same thing, you have to mention whether you would have invested in that company or not, maybe by giving quick reasons, right? So in the case two, basically the first startup is a startup which has a website wherein patients who have cancer or their relatives can apply to find the right treatment choices depending on their budget, cancer type and all. Because like if you have a breast cancer, the hospital should have a certain kind of infrastructure, and as a consumer you don't really know, which is the best hospital and all. Idea is that you apply to the website, they will hear your doubts, they will engage with you through a progressive web app, and then they will guide you to the correct treatment destinations. The timing is 2020, very recent. Founders are good founders, they're senior founders, so no issue around the founders. Traction is, there is no traction as of now, and the mentality of the founder is that we believe the problem is real and we will need funding to execute it, right? So this is one startup. Another startup is a startup which is developing a mobile based a CRM tool, right, for the Indian SMEs, right? So basically, you all would have heard of Salesforce. Salesforce is a it works for big enterprises, but these guys are developing a tool maybe for a small distributor who has some customer here and there, right? And what the product they claim can do is, one, currently they are noting things down on paper. Ki, "Acha, this can be a potential client for me." That happens on bits and pieces of paper. They can digitize it, and then they can also send automated reminders, WhatsApp messages to their prospective sales leads, send digital bills and all. Timing is 2020. They have the tailwind of the SME adoption of softwares. Founders are pretty good, they're from good colleges. Again, no traction. The founders believe that once they get funding they will execute, right? So yeah, I think I already have two answers, one from Suvarna, Ravinder, Jay. Everyone is super excited, I think, about both of these companies, and everyone is, I think, willing to invest. So good news for both the founders. Anyone else, who has a different opinion here? Okay, so cool. I think good to see the huge investor interest in these startups. But yeah, here the challenge that I would like to point out is that the common thing that you guys would see in both these companies is that both the ideas are good ideas. Ultimately they are ideas that the customers might most likely need. But if you look at it, the common thing is that none of these startups have any traction, right? So in both the cases, the traction is nil. So basically, the founders have not done anything, and they're coming to raise capital without any traction at all, right? So now this brings me to the second very important parameter when you are reaching out to investors, particularly at early stage, which is the basic proof of concept, right? And to be honest, guys, it's not very difficult to do a basic proof of concept of what you're trying to do, right? So if we just go back in both of these examples, the first example, right? I mean, if you can just create a basic website, right, and start doing some digital marketing, probably some people will apply, right? And then you don't really need to create a full WhatsApp based product. You can yourself engage with them. You can yourself call the patients, understand their problem, and then tell them that, okay, according to us, these are the 10 hospitals you should apply to. And you don't really need to have a professional tie up with the hospital on fee sharing and all. It's okay. You as of now, you just need to show that you are able to guide the patient. They are able to select their treatment destination through you. So doing that POC, spending a little bit of money on digital marketing to acquire some patients is not very difficult, right? But the unfortunate thing is that this startup has not done that at all. Likewise, in this case, to develop a very small miniature version of the final product, right? And they might not have so many features. They might not have the feature to do automatic WhatsApp messages, digital bills, automated reminders. They might not be there. But something, even a very basic Excel kind of dashboard, wherein someone can actually just track his leads, and also collaborate with his or her team members. That's not very difficult to build. But the founders have not built that. So this is something wherein the VCs would constantly be judging you, that what have you done till now, right? And when you're designing a proof of concept, all the time you need not have the full product right away. But even if you have some initial essential features, some core features, that's fine. And the product need not be aesthetically very good. The POC can be scratchy. Sometimes you can combine existing tools and create that POC. That is something that you should ideally be trying to do, right? And all the time, you might feel that I don't have money to hire employees to create the product. It's not needed. If you have to create a very simple product, there are no code, low code tools out there, and you can hire some interns. You can save some money through your current job, and you can do that, right? It's not very difficult. This is something, if you've not done, then it really reduces the chances of you getting funded, unless and until you are a very, very senior founder, right? And the important thing that you have to demonstrate from the proof of concept is some early signs of product market fit, or rather you should show problem solution fit. That is very important. If the problem that you have identified, if you can show that I am able to bring some users who are benefiting from what I'm doing, then there is a good it really excites the VCs, right? So and there I'll just give you guys two quick examples of two cases wherein I talked to some startups and I really liked the way they had designed their POCs, right? So there's one company which was doing the theme was that today there are a lot of financial influencers who are giving tips to people around what kind of stocks they should invest in and all, right? And they have a huge fan following on LinkedIn, but their thesis was that LinkedIn is not the best medium, or WhatsApp is not the best medium. We should create a separate kind of Instagram kind of platform only for such influencers. So now creating a full-fledged such platform is very difficult, but they had to show that there is a need for this kind of engagement, and the influencers sometimes will need to access some analytics of how a particular stock is performing. They might need some data about how their particular follower, how his portfolio is shaping up, right? So what they did was that they created groups on Discord, wherein every financial influencer got a group, and he was managing maybe 30-40 people. He was every day giving some tips, and the founders of this startup, they were constantly, whenever the influencer needed some financial information, some market information, they would bring it to him. They will send him screenshots which he could publish on the Discord group. So in bits and pieces, they were getting a very scratchy POC done, and they were showing that much better engagement can be derived if you have purpose built mechanisms to facilitate this kind of an interaction between the influencer and the user. And I really like the way they had thought through the POC, and they, through this process, by talking to a lot of influencers, they figured out exactly the kind of product they have to build, right? So which kind of like content creation tools the influencer needs, what are the kind of dashboards that the end users need, right? So this I really liked. Unfortunately, we were not able to invest in this company because there was a valuation mismatch, but yeah, it was good. So likewise, there was one more company like this, but again, because we have lesser time, I'll not, maybe we can touch upon it later. But long story short, try to do at least some kind of proof of concept about what we are doing, and I will come back to it this again later in some time, in the second half of my presentation, right? Now let's come into another case, right? The third case. So this case is, and again, I would expect you guys to give your inputs, right, on whether you would have funded it or not. So this case is, the time is sometime in 2018, no corona. The idea is that so there are a lot of these top level hotels, like probably Hotel Ramada, Hotel Lalit, Ashok, and all, and as regular individuals, basic salaries, staying in those hotels is an aspiration, but we can't, because we can't afford them. So what happens is that what this startup does is that it collaborates with these hotels, and they have last minute inventory data about these hotels, that they know that there are 10 rooms in Ramada, and there's no booking for them tomorrow. So where the room is actually priced for 7,000 per night, they will say that, okay, let us market it for 2,000 per night, right? And they will market it to users, and some users, for luxury and for aspirational value, will come and use it, right? So that is what they were going after. Senior founders, they were very good at operations. They already are having about 1,000 bookings a month, right? So what do you guys think? Do you think that this is something worth taking a bet on? Now, I hope you guys have understood what the startup is doing, right? I mean, Ravinder is in a great mood today. I mean, had he come with a checkbook today, every startup would have got funded. Prateek, very similar. Okay. Kashish is doubtful, right? So fair enough. So cool, but like I'll and Jitendra had said no. So so yeah, and I now see some important points being raised. Like Piyush is asking, won't it affect the brand name of these hotels and all? So okay, thanks guys. I think this is a great interaction from your side, and so yeah, for those people who felt that it's worth investing, it's true. Ultimately they are solving a kind of a consumer problem, right? They're doing a certain kind of matchmaking, but the fundamental problem that a lot of people might have with something like this is that what is the market size here, right? Ultimately, how many people want to go and stay in hotels just for one day aspirational value? And even if they stay for one day, will they keep doing that month on month again and again? So what is the lifetime value of the users, right? And one important point was raised by Piyush here, is that actually a lot of bigger hotels might also not want to be a party to something like this, simply because they might feel that it's going to affect their brand value. So this is something which is definitely going to get traction. And actually something like this startup actually existed, and I personally used it. A lot of me and my friends used to go and spend some time in fancy hotels, but then we realized that we can't be doing this every month, right? It does not make sense, right? So this brings us to a very important point, which is the market size, right? So if you are doing a startup, ultimately it's very important for you to be going after a venture which has a huge market potential. You can build a big iconic company. And what do we mean by a huge market potential, right? So what I say is that ultimately your startup should have the capacity in the steady state, in the positive case, to reach a $5 billion or even more kind of a valuation, right? And I'll tell you why this is very important. A lot of people say that, okay, but I am creating something very exciting. It might not become very big, but at least I can become a $50 million company, or I can become an $80 million company. What is the problem in that? The point is that you have to understand that when you are doing a fundraise, the VC is your customer, right? And if you understand your customer well, like in any sales process, you will be able to do the sales well, right? Now VCs have also raised money from other investors. It's not that they have been born with that money, right? And they have a lot of pressure. I am also a VC. We have a lot of pressure to return capital with very good returns to investors. Now, if we just give very basic returns, then people will question that why should we invest in your VC? We will just invest in the mutual funds and all, right? So typically, if a VC raises 100 million, right, and they invest in 10, 20 startups, you guys also know that most of the startups don't work out for whatever reasons. The team falls apart, some other problem happens. So 1 out of 10 startup is going to succeed, right? And for $100 million fund, if they have to return about 300 to 500 million, and then they invest in about 20 companies, assuming that only two will work, from each company they should be able to make about 200 to 250 million dollar, for while having a stake of maybe 10%. So the company, you can imagine, the company should be valued at 3 to 4 billion dollar, right? So when the VCs are investing, they know that a lot of these companies will fail, but their thought process is, even if one bet succeeds, this is the huge upside that I can make from this bet, right? So that's why the market size becomes very important. So a lot of times you might be able to raise from angels at a fair, even if there are some doubts around market size. But if the market size does not look big enough, then it's very unlikely that VCs are going to take a bet, even if it's a very exciting thing, right? So let's say, like, you create a very IoT enabled rugby ball, for Indian customers. VCs are not going to invest because Indians don't play rugby, right? So you have to think of those lines, right? And so one aspect about the market size and adoption is the actual potential market size, that how many people might end up using your product and how much can they pay. And the second aspect is that sometimes the VCs might also have some doubts about, even if your product is good, will enough number of people in the market actually adopt that product, right? And going back to and this is kind of also linked to the timing, right? So if we go back to the Khata book example, maybe 5-6 years back, a lot of people would have doubted, will Indian small Indian retail stores, they have illiterate shopkeepers running the stores, will they adopt mobile technologies? But the fact of the matter is that they did. But that doubt is always going to remain around the market in the minds of some VCs, right? And sometimes you can't do anything. You have to live with it and you have to ignore that VC, right? So basically, we have touched upon three factors till now. I'll just go back. One is the timing. The second is the kind of proof of concept that you have done, and the third is the market adoption. Now, the fourth very important parameter that I would want to touch upon is the team, right? And here I'm not really presenting a case, but I'll just want to highlight that when a VC is looking at your startup, and this is particularly at the very early stages, if you, like, for VCs like us, wherein we invest in the pre-seed and early seed stage startups, these are mostly founders' first investment, right? So more than anything, the biggest focus will be on you and your other co-founders. What does the team look like, right? And some essential good to have things, so how do people evaluate teams? So one is that having just one founder is not enough, because the journey of a startup is going to be very tumultuous. And as a single person, you might get lonely, you might not be able to cross that hurdle, right? You might get complacent and all of that. So all the time, like in 90 out of 100 cases, VCs would want more than one founder in the team, right? And each founder should have some substantial equity. Our best case is that all of them have equal equity, but maybe someone has 60, someone has 40, that is also okay, right? uh, Another ideal case would be that founders should have worked together before, right? This is very important, because ultimately, being co-founders is like, it's like marriage, right? You guys have to make it work, and you guys are going to have a lot of differences in opinion as your company grows. The difference could be as simple as, when you have to hire a CFO, right? So you might want to hire person A and someone else might want to hire person B. So there's going to be that difference of opinion. So all sorts of problems are going to be there. So the point is that if you have worked with each other before, for a substantially longer period of time, you know each other, you know how that person thinks. And despite that, if you're willing to work in a venture with that person, it's a more comforting idea to the VC, right? Another thing is, founders should ideally have complementary skill sets, right? Because a lot of times what happens is that there are teams in which there are two founders, both of them are hardcore techies, right? but someone has to do business also, someone has to do sales, and they have no clue about sales, they have never done it, right? So that's also not a great position. I'm not saying that someone who's a techie cannot pick up sales, he or she can, but the ideal position is a combination wherein one person is good in sales, one person is good in product and tech, and if needed, if there's an huge operational component, one person is good in that, right? The next point is a very important point, which is a founder market fit. So that is something that the VC is going to look at, right? So let's just take some cases of founder market fit, right? So let's say you are a company which is creating a solution for large enterprises. So companies which have more than 1,000 employees. So something like Fortune 500 companies or Fortune 1,000 companies or whatever, right? So to these companies, if you are going to sell a software for which you are going to charge maybe 200,000 or $300,000 a year, they are not going to buy it in online, or they're not going to buy it in one meeting. So there's a proper B2B sales process that goes into that, right? And if the founding team does not have that sales experience, having been there, done that, then it can get tricky for the team and for the VC to take the bet that, okay, these are young college graduates. Will they be able to talk to the CIOs of such big companies? Will those CIOs even entertain them? So those questions are going to be there, right? So like in a very startup selling to big enterprises, having a B2B sales DNA in the team is very essential. Likewise, a startup which is something like, let's say, a share chat, right? So they don't really have a door-to-door sales kind of structure, but having a founding team which is very good in quickly creating and iterating products, so having a very strong digital product DNA is very important. So VCs are going to look at this, right? That the kind of venture that is to be built here, does the founding team have a kind of matching DNA there, right? And then there is a very controversial topic that a lot of people say that VCs have this IIT, IIM, Ivy League bias, right? I am also from IIT, by the way, but we don't have a bias. Out of the 25 companies, I think 50% are not from these colleges, right? But the point that I want to emphasize here is not whether these biases are correct or not, but what is important as founders for you guys to know is, why are these biases there? So it's not that the bias is there because the VC partner is also from IIT Delhi and the purpose of his life is to promote founders from his alumni. No one cares so much about their colleges, right? The purpose is that VCs want to, because if you are doing a startup, you have to constantly be in a problem solving mode. No one knows what is going to be the perfect GTM, go to market strategy for your company. Tomorrow, you might not be able to do sales properly, you might get stuck in hiring, so you will constantly encounter difficult situations, problems, and you have to think and improvise and come out of those situations, right? And these examinations, the preparation, these are difficult examinations. So getting into an IIT, IIM, and Ivy League college is not easy, and it's a challenging path, in getting into each of these colleges. And each of the students who have got into these colleges typically have gone through those challenges, gone through those grind, and they have somehow figured out a path, to find a solution. And that is encouraging to the VCs. This person, when he was given a challenge, like get through this examination, he was able to get through by hook or by crook. So if he have demonstrated that once, he can perhaps demonstrate that again. That's what gives them confidence. However, if you are able to show, even if you're not from any of these colleges, but if you're able to show that you have been in that situation before and you have come out very strongly, so let's say you have worked as a early employee in some startup, you owned a particular vertical, let's say you led the sales for a startup in North India, you faced all these problems, all, then that is going to give people confidence. So that's why, in case you don't have any of this, tell the VC that, yeah, I have not cleared these examinations, but you see, these are 5-6 times when I have been in very tough situations, or I have taken a big challenges. Like I organized a huge event in my college, and the sponsorship was 10 lakhs. I increased the sponsorship to 1 crore. So that is going to give confidence to them. And the last important aspect around the team is the level 1 hiring, right? So this is again very important, because ultimately, while most of the companies are founder first companies, but ultimately 2-3 founders cannot create huge iconic companies. You need to be able to get a very good team, right, to work under you. So one, you need to have leadership skills, and second, you need to have a pool of talent, because if you are raising a 2 crore round, how much can you pay a good person? You might not be able to pay, because the big companies are also giving very high salaries. So you should be able to convince that potential employee that come and join my startup. I will not pay you so much, but I will probably give you some equity and all of that, and it's going to be a great experience and all of that. There's actually a very good ad by the late Sushant Singh Rajput around that, something around a Titan ad, right? Wherein he says that salary zyada nahi de paunga, but udne mein maza bahut aayega, right? And that is the confidence you have to inspire, and the VCs are going to ask you, ki yaar, okay, if I'm going to give you 2 crores, whom are you going to hire? Do you have some people in mind? And if you are point blank and you're like, I don't know, I'm going to check on Naukri.com and AngelList and all of that, then it'll become a bit of a turn off, right? So this is a very important factor, right? The team, right? And these are different verticals in the team, right? So now, before we go deeper, and I'll just probably take a pause and see, if any of you have any specific questions here till now, and you can probably put it in the Q&A quickly, because that's how I wanted to do it. Post which I will go to the next part of my discussion, right? Okay, so one of the questions is that how do you figure out if the timing is right or not, right? So like I said, this is a bit of a subjective thing, but you have to think for yourself, so like, and this is not something that I can answer in one specific case, but just think about it. Like I gave you let's take the example of women, right? So if you are creating a product, which is catering to women, right, then ultimately women will need to pay for the product, right? And if you go 10 years back, maybe in 2010, there were very few women in the workforce anyway, right? So you know that the actual market that you are targeting, not enough number of people in that market are in the paying position. Compare that to now. It's not that we have given enough opportunities to women yet, but still you see a lot more women in the fray today, right? So probably this is a better timing wise, a better time to create something for women, right? Okay, so I think there's another question that cool. I think what I'll do is that probably I'll touch upon these fundraising frameworks also, and then probably we can get to these questions because I think the timing is a bit limited, right? So now coming to the fundraising frameworks. So ultimately, like I said, fundraising is going to be a process. It's like a sales process, right? So you will face a lot of rejections. So there are different mental frameworks, that you as a founder can have. The first mental framework is a very emotional framework, right? So let's say you get rejected by a VC, you become very angry, right? Because the reason is most of the founders feel that in their startup there is no risk, right? And then they feel that why is the VC not investing in my company, right? Just because I'm not from a top college, or just because I don't have enough capital to show him a lot of traction, he's not investing, and there's a VC is biased and all of that, right? So, and when they hear a no from an investor, they feel sad, angry, and all over the rejection, right? And partly this behavior is very natural, and it's also good, because as a founder you have to have utmost belief in your venture. But ultimately this emotional framework of looking at your fundraise is not perfect in my opinion, and a better framework is a more, I would say, an objective framework, wherein as a founder, first of all, understand that what you are building is inherently something risky. There is a very high chance that what you're building might not work out, because 99 out of 100 cases when people have tried to build something similar, it has not worked out. Startups have failed. This is the fact, right? And then you need to write down the risks, right, in your venture, and you have to figure out that in which aspect there's a higher risk in your venture, right? So and I'll give you guys our personal example also. So as PointOne Capital, we have also raised capital from investors, right? And one way to look at it is that, okay, we are starting an early stage fund, we will invest in the best companies, and all the companies will do very well. But we realized that people had some of the questions around our model. There are some inherent risks in our model as well. That what if we are not able to get the best founders to come and raise capital from us? And what if even if all the good founders came to us, what is the guarantee that we will necessarily take the right decision, right? So there are some risks associated with our fund. Likewise, there will be some risks associated with your venture as well. And when you get into this objective framework of understanding the risk, whenever a VC says no to you and the VC will give some reason, you will understand, right? That okay, this VC could not get enough confidence in my team, or this VC feels that whatever little traction I have achieved, that is not enough to convince him or her, right? And this will first of all make things simpler for you, and also going in a more philosophical direction. This is a very important framework in life in general, because whether it is a startup or not, we are all going to, in some parts of time in life, going to face rejections, be it in job applications, be it in relationships, be it in fundraising, right? Now you will be mentally okay with rejections if you put yourself in the shoes of the person who's rejecting you, right? Then you will not feel depressed, and you will try to improve yourself so that you're not rejected for the next time, right? So this objective framework is there, and for you to be able to use this objective framework properly, you need to understand that which are the top risks that investors fundamentally see in startups, right? And we have already talked about four risks. We have talked about the team risk, we have talked about the market size, market adoption risk, we have talked about the execution risk, which is definitely a very high risk if you have not done any proof of concept, and we have talked about the timing risk. I have not talked about the business model risk because it is very detailed, and at very early stage most of the investors are okay to take a business model risk. So in this particular lecture, I'll kind of skip that, right? Now what I will do in the course of the next 3-4 slides, I will try to give you guys ways in which you can help a VC mitigate, overcome each of these risks. And I'll tell you, there have been cases before wherein a startup pitched to a VC. Immediately the VC said no, I'm not able to build that comfort, I'm not able to cross the line. But the startup kept the VC updated, and maybe after 6 months the VC invested. So basically the founder helped the VC overcome that mental risk that they saw in that particular startup. So we will go through the top 4 risks one by one and how we can mitigate that, right? And so basically, again, as when you fundraise, your job as a founder is to help the VC overcome these risks, right? So one risk is the team risk, right? And sorry, the font is a little low, but how can you mitigate the team risk, right? So one is that try not to be a solo founder, right? Ultimately we are all, we are coming to events, we have our friends, we have our college juniors, seniors and all. So try to reach out to people, try to get some co-founders, who have typically who have complementary skill sets. Or if the co-founders don't have complementary skill set, if you are just 2-3 friends who really respect each other, like working with each other, then try to develop complementary skill set. Okay, you decide, okay, there are 3 of us, Mr. A, Mr. B, Mr. C. C should go and try to learn coding, B should become an expert in digital marketing, and A will handle fundraise and operations and all of that. Spend time working together. A lot of times we just go to the VC and said, okay, 3 of us have got together to do a company. VC will think, okay, but you have never worked together really, right? And you're great friends, but working together is a different thing. So tell the VC that, okay, we will do some execution for next 6 months and come back to you and tell you that how we are able to establish that camaraderie between us, right? Then another very important thing is have people vouch for you, right? And this is very different. Having someone vouch for you is very different than having someone say good things about you. And I'll tell you the difference between both. First, the second part, someone saying good things for you. So let's say you are in a job, right? And you are a very disciplined employee. You come at 9 a.m. every day. You complete your work, whatever is given. You don't fight with anyone, obey your boss. You have no other like sexual offense or anything like that in your name, right? So anyone will ask that, okay, how is this person? The manager will say, good guy, good person, right? But the manager will not be able to vouch for you because you have never done something beyond your like comfort zone. So you have not really gone out of your way. So as you guys are working in your current jobs or anything that you're doing, whether you are training for a particular sports or anything at all, try to do things which push you beyond your comfort zone, right? And when you do that, you will inherently show a lot of tenacity and discipline to people around you. People will respect you automatically. And what will happen is, anytime someone asks that person about you, they will say, oh, he's a great guy. I have seen him do things which seemed completely impossible. So and most of you might be working in startups. When you're working in startups, you will get these opportunities. In MNCs you might not get, but in startups you go to your manager and say that I don't want to be just doing this simple job, give me something more challenging. Don't make me just a simple sales executive. There is this area, let's say northeast, you don't have a presence, allow me to go and develop your set up the sales operations there. So take up challenging things, right? It will help you grow as a person, and it will, if you succeed, if you do it well, people will be able to vouch for you, which is very important for a VC. Show skin in the game, extremely important. A lot of founders say that give me capital, then I will start working on the venture. I mean, it's not correct, right? Ultimately, as a founder, you are the first investor in your company. If you are not willing to show skin in the game in your company, if you are not going to put in some capital in your company, why do you expect the VCs to do it, right? It's very important, right? And then between founders have clearly defined roles. So you shouldn't say that all three of us are CEOs. It does not work out. There has to be one person who owns all the CEO role, one person who owns product, like I've said before, right? So that demarcation should be there. Keep talking, convincing potential hires. Again, if like today, if you talk to a VC, they ask you whom will you hire, you have no clue. But after 5 months, you can go and tell him that I have talked to these 5 juniors that I had from my college. I have been able to convince them to come at half their current salaries, because I have been able to convince them about my venture, right? And like I said, give some case studies to the VCs, that how you have overcome difficult situations in life in general, right? And I would have loved to share an example about how one of our portfolio companies was able to mitigate the team risk, but I think we have just 9 minutes to go, so I'll probably reserve it for later, right? The second risk is the market size adoption risk, right? So now the thing is that this is a very subjective thing. First of all, the market size fundamentally is not in your control. Like I told you, a very boring example that I gave is that if you are creating a special kind of IoT enabled balls for rugby players in India, ultimately Indians don't play rugby, right? And whatever you do, you can't change this fact overnight, right? So in a way, you will not be able to completely change a VC's perspective, but sometimes there are some gray areas in the market size. So VC might feel people will not adopt this, right? Even though your solution is good. So then after 3 months, go to the VC and say that time I had just 10 people using my product, today I have 100. After 3 months, show that now I have 500. That will at least give VC the confidence, okay, people are actually adopting it. Sometimes when VCs are not very confident of your immediate market size, you can show some upsell opportunities, that okay, this is my initial product, but once I get the customer, I can make these products as well. So keep the VCs updated, show him your thinking, and keep doing experiments. Once you have enough customers, also create that upsell product and show the VC that, see, my upsell product is also working. That is going to give him confidence, right? And sometimes what happens is that sometimes, even though the market is not huge, and I'll give you an example here. Let's take the market of Salesforce, right? So sales is something that all the organizations all over the world need. Everyone is doing sales, right? So, and you all would also be aware of the term called sales. But I am pretty sure that very few people, and there are 91 people here, I think less than 10 people would have even heard of a term called pre-sales, right? So very few people know about pre-sales, right? But pre-sales is something that exists. And there was this startup called Prescale, which came to us, and they were doing a software for pre-sales teams and not the sales teams. And we felt that, okay, pre-sales is not such a big market, obviously. But what we realized is that while it's not as big as sales, it's big enough. And not too many startups are going to create solutions in that market. So if this founder can create a solution for this niche market, but they can grow very fast, then they can take a very high pie of this market. So if the market size is not huge, you have to give VCs the confidence that you can grow very fast and you can get the maximum chunk out of that. Otherwise, if the market size is big enough, even if you get a small chunk, you will still become a big company, right? So these two things you have to keep in mind. This is how you can mitigate these risks. The next is the execution risk, right? And guys, if we go back to this slide again, right, these risks that we have mentioned, I have put the execution risk in red. And there's a reason for that, is because ultimately after a point, like I said, you can't change the market size. After a point you can't change the team also, because like if a VC really has bias that I will not invest in someone who is not from IIT, you can't get into a time machine and go back and get into IIT. You can't do that. That thing is over. You have to find a new VC. But this execution is something that is completely in your control. It is perhaps the only parameter that completely is in your control, right? And I have seen a lot of cases wherein the founders have no clue about how to do a POC. Most of the time they will say, I have no money to do a POC, right? So I'll repeat, you don't need to have 20, 30 lakhs to do a small proof of concept, right? But, you should be able to spare at least some capital from your current job, right? And let's say you want to do a startup now and you don't have any capital, because you have not been saving, you have been partying. Then right from today, you should start saving, right? And once you do that, that moment you start working for your startup, because somewhere you are getting that initial funding for your startup from your own pocket by saving, by not partying, by not going on vacations and all, right? And it's not very difficult in today's scenario to save around 1 to 2 lakhs, right? If even that is not possible, go and take a small loan from your parents. Everyone has some chacha or mama who is very rich, right? Even if that is not possible, a lot of these colleges, there are grants, government grants floating around. Colleges are giving 5-10 lakhs to promote entrepreneurship, right? So if the intent is correct, it's not very difficult to get some capital and like create the POC, right? And the POC should be well defined. You should understand the customer profiling that you're targeting the POC. You should be able to develop some user journeys. If you do a POC, then you should be able to show that customers actually benefited from the POC, right? That is going to give the VCs a lot of confidence, right? So so overall, this is very important, right? POC, I would say this is the most important thing. And you should plan for it. Don't have these excuses that I will only start working on this idea once I get funded. It's a huge turn off for investors, right? And last thing is the timing risk. So on the timing risk, what I would want to say is that timing risk it's very subjective, right? And ultimately, look, you need to understand where you stand in the spectrum, right? So as an example, if we were to again go back 5-6 years back, it might not have been the best time to do a startup that enabled investing in stock markets, because still a lot of Indians were focused on investing in real estate and all. But if you were still doing such kind of a startup, you would know that the tides are turning, right? So if I persist long enough, then I might reach a point wherein the market reaches the critical mass and enough number of people start investing in stocks, and my solution can work, right? And so you have to do a little bit of self introspection, understand how the market is changing, when the timing will get better for you, and whether you are willing to wait for that much time. If you're not, then stop your company, right, and do something else. If you are willing, then you will have to show some persistence. People might not immediately invest in your startup, but that's okay. If you believe in something, that's it, right? So I think we have just reached 4:30. I really did not want to exceed the time, so I will just stop here. I would have loved to give some examples to show how some of our portfolio companies have actually been able to mitigate those risks, but probably that's for another time. And I will just end by saying that keep hustling, keep building, all the best. Ultimately, as a founder, you are running the ship, right? So if you have confidence, if you have belief in what you're doing, then sooner or later you'll find a way, right? So that's from my side.